Friday the 10th of January sees the first jobs report of the year coming out of the US. And the way it's going is going to play a key role in terms of market expectations and sentiment going forward as we move towards the entry of Donald Trump into the White House. We're looking for plenty of volatility. So let's look at how markets could be impacted by the jobs data released over the course of the week. So here is a breakdown in terms of market expectations according to Trading Economics. And it's important to take this with a pinch of salt because we've got plenty of variation when it comes to expectations for that payrolls figure. We can see here the expectation is that we're going to drop down to 200K from 227. Remember, we've seen plenty of volatility recently with the 12K mark being upgraded last time around, but then we saw a big pop up to 227. So wide swings when it comes to the payrolls numbers. An expectation widely, though, that we will see a move lower this time around. Unemployment expected to rise to 4.3. This is the key point. It rose to 4.2%. If we continue to see unemployment rise, then there's question marks about whether that might force the hand of the Federal Reserve, especially if we see lower wage growth. And that is expected on a monthly basis with 0.3% down from 0.4. It's still above where they need to be if they want to get it down to 2%. But I would say arguably average hourly earnings around 3% is something that's relatively normal. They don't necessarily have to get down to the 2%. That target is for inflation rather than wages per se. But certainly if we see some downside in terms of wage pressures, higher unemployment rate, it could start to point towards a possibility of the Federal Reserve cutting more than markets are currently pricing. Participation rate, interestingly enough, expected to rise 62.8. And so the participation rate rising can actually lead to a higher unemployment rate because people come back into the market, may not necessarily have a job, but they may be looking for a job. And suddenly you have a huge amount of people that are now counted in that headline unemployment rate. Whereas the U6 measure, which is total unemployment, shouldn't necessarily be affected the same way. But that is expected to also rise 7.9 up from 7.8 expected. So that's the outlook we can see here in terms of the sort of overview of where things stand at the moment. You can see arguably unemployment rate basing out and gradually starting to rise. The non-farm payrolls on a downward trajectory. But like I said, we've been seeing significant variance over the course of recent months with sharp moves higher, then a sharp move lower. And, on average, the trend is towards the downside. Average hourly earnings gradually moving lower, but we've been sort of stuck in the mud, I would say, over recent months. And again, participation rate, similarly, sort of sideways price action for some time now. Arguably, you can't call it price action because it's a participation rate and not a price. So the breakdown for the non-farm payrolls, we can see here in terms of where jobs are being created, where jobs are being lost. You could see a sharp downside move in terms of manufacturing from the prior month. That was regained to a large extent. And actually, we've actually seen a stronger than expected manufacturing PMI number, ISM manufacturing figure on Friday. We're going to be looking out on Tuesday for the services figure, which is going to be even more important. But certainly, we have seen significant strength around the leisure and hospitality sector in particular in 2 of the last 3 months, notably. But like I said, significant variance when it comes to each month. It feels like one off, one on in terms of the performance of the payrolls figures. And given the fact that we've just had one on, will we see it underperform this time around? Well, like I said, there is significant variance in terms of expectations. That Trading Economics outlook of 200K is over and above all of the forecasters that we have here. I've got the top 20 forecasters, but I've stripped out all of the forecasts that haven't actually provided anything thus far. So you can see there's no 4th place, there's no 8th place, etc. But what we can see here is generally people are looking for sort of 180 kind of mark down to 150. The 150 mark features quite heavily within this list. So there is a good chance that we do see a figure well below that 200K mark. And if we come down towards 150, there's a strong chance that people start to say that that's a sort of underperformance this time around. But like we've seen here, some of the sort of top forecasters have provided that as their base case scenario. So that's certainly something to be watching out for. And the possibility of weakness brings in the whole bad news is good news rhetoric once again, because there is a strong chance that a higher unemployment rate, a weaker jobs report as a whole, when it comes to payrolls and the like, lower inflation, those are the kind of things, or wage growth, those are the kind of things that could provide us with a more optimistic outlook in terms of the Federal Reserve. What we have seen is a deterioration in terms of the City Economic Surprise Index, and that's in the yellow line here. That deterioration took us back towards the sort of flat area, but actually we've seen things pick up and improve a little bit recently. And that doesn't necessarily sort of help things when it comes to that idea of where things are going in terms of monetary policy, because if we were to start seeing significant underperformance or deterioration in terms of US economic data, below that line, essentially, that's when we start to see the pressure being put on. But we haven't. We've seen that sort of outperformance ease a little bit, but now we're starting to see a move towards the upside, and that's for a large part why we've been seeing some of these significant gains over recent months when it comes to bond yields in the US. It's the strength of the US economy, and that economic surprise index from the Citi group has provided that outlook, has provided that view of that occurring. And certainly if we were to see that drop back below that zero threshold, then it could start to weigh on yields. But at the moment, we're not necessarily seeing that. Like I said, we saw that ISM manufacturing report. I just wanted to break out the employment section of that 45.3, so below that 50% threshold here. But arguably, really, I would say that the services sector is going to be more important, and that's going to be coming out on Tuesday. Then we're looking at wages in relation to inflation. So where do we stand in terms of wage growth? Where do we stand in terms of core CPI? You can see the relationship between the two in the top section when it comes to average hourly earnings being the light blue line, core CPI being the purple line, and then the month-on-month wage growth figure coming in terms of the sort of bars in the top section. And you can see they've sort of ticked up recently, and that has been reflected in the bottom section with the 3-month annualized growth rate. Generally, that sort of gray band is where we were pre-pandemic. We sort of got into that area, and we're now back above it. But certainly it does point towards the fact that markets don't necessarily need to see inflation sort of back at 2%. But certainly getting towards 3.5%, 3%, that would be the kind of position where it wouldn't necessarily provide the basis for concern when it comes to underlying inflation pressures for the Federal Reserve. In terms of unemployment, well, we are talking about the possibility of another tick higher when it comes to unemployment. But if we look compared to some of the other major economies out there, the US is doing relatively well. It's in the low 4s, and it's rising, but it's a gradual trajectory. And it's certainly not rising at the same pace as the likes of New Zealand and the likes of Canada in particular. And so it is following, by and large, the trajectory of many of the other countries. But that upward trajectory is a more sort of shallow slant, I would say. And so I wouldn't necessarily worry that this is suddenly going to spike into something major per se. But certainly if we were to see an unemployment rate rise and a weaker payrolls figure, that at least forms a wider narrative in terms of a sort of weaker picture when it comes to the jobs market. In terms of the unemployment rate, like I said, it has been ticking higher, but we haven't necessarily seen sort of lift off thus far. If you sort of overlay the ratio between the hard to sort of conference board surveys, hard to find jobs versus plentiful, we have seen a pickup in terms of the ratio of those finding it difficult to find a job versus those finding it very easy. But notably, that has come down pretty heavy recently. And it's something I wanted to sort of dig into a little bit more. And we can see those two split out on their own, where that decline in terms of those finding jobs plentiful has turned on its head at the same time that people finding jobs hard to find has also reversed towards the downside. So arguably, when we're looking at, like I said, with that Citi Economic Surprise Index, the pickup that we've seen recently, we're seeing the same kind of thing being highlighted here in terms of the conference board jobs ratio and some of the underlying metrics. Obviously, when we're looking in terms of outlook from the Federal Reserve, the ability of the economic data to influence what the Fed's doing, and wage growth, and why people might be concerned about inflation or not, it comes down to this, right? So where are we in terms of headline CPI? Where are we in terms of core PCE? Both are on the rise, although the PCE figure only gradually so. In terms of the monthly metrics, you can see certainly the sort of green line, which is the CPI figure, has been on the rise for those monthly figures. The last two numbers have been a little bit concerning, with the 0.3 on the last one. So that's moving in the wrong trajectory. And we haven't necessarily seen a massive uptick in terms of energy prices. So certainly that does highlight the fear that if energy were to surge, because we have been seeing a bit of a push higher recently, then that could push that headline CPI figure higher once more. In terms of the PCE figures, you can see that, you know, by and large, we saw September and October were above where we need to be to get back down to 2% target. But aside from that, I would say over the past sort of 6 or 7 months, it's been relatively on target. And so in actual fact, I should have changed the label for this. You see the 5-month annualized section at the bottom. That's actually 7-month annualized. I'm basically trying to say, where are we once that big chunky section on the left-hand side of the middle chart, the month on month, once that January through to April section is stripped out, where will we stand? So what trajectory are we on after that period? Because I'm aware of the fact that, you know, we're going to get into a phase where we're likely to see disinflation in a very meaningful manner at the beginning of this year. And we can see that at the bottom, right? So CPI expected to drop down below the 2% mark at 1.78, and core PCE on target to reach 2.2% once we see us strip out all of the figures up until April. So basically, where will we be by May time? That, you know, for the most part, could provide the basis for the Federal Reserve to feel a bit more emboldened about the possibility of taking further action. Markets at the moment not pricing much, quite frankly, when it comes to interest rate cuts. But there's a possibility we could see more. This is the relationship between the Eurozone and the US 10-year yield, and then overlaying that with Euro dollar. We have been seeing it picking up a little bit of late, and I'll show you that in sort of real time. But certainly there's sort of different reasons behind that. You could say, oh, maybe people are starting to price in more rate cuts from the Federal Reserve. I think that there's a case that some of the question marks around the Eurozone means that people are sort of requesting higher yields, despite the fact that they're cutting interest rates going forward. So really the two are sort of battling against each other, and they're being sort of counteracted. We've seen some more weak data coming out of Germany, in fact, just this week. And like I said, in terms of the outlook from the Federal Reserve markets, not expecting much. There's something like 15% chance that we don't see any rate cuts over the course of the year, according to the CME FedWatch tool. But the base case scenario is 25 basis points, with the second likeliest, not that far behind it, of 50 basis point cuts, 50 basis points worth of cuts. So there's a lot of indecision. Markets aren't really expecting much. The Federal Reserve have laid out a dot plot that essentially says we're going to get 50 basis points worth of cuts. And the minutes released this week will provide a really interesting backbone for that argument to play out, and for people to become more informed in terms of what is likely going forward. But like I said, I think there's a good chance that by the time we get before the end of the first half of this year, I think there's a good chance that we see inflation coming down in a really meaningful manner. And a lot of it's going to come down to what Donald Trump does. And we've kicked off the week in a very bullish fashion. And some of that is down to a Washington Post article that pretty much said Donald Trump is, in actual fact, not planning to see huge tariffs across the board. He's going to be quite targeted in nature. Now, Donald Trump's pushed back against that. But who knows? You know, certainly if we were to see a less aggressive approach to tariffs from Donald Trump, then that could provide the basis for outperformance for markets and expectations of further easing from the Federal Reserve. And then at the same time, in terms of what happens for inflation, there's an expectation that inflation is going to rise with Donald Trump. I don't necessarily think it's as likely, because, like I've said a number of times, inflation is more of a services-led problem right now. Goods inflation is not a problem. So a little bit of goods inflation, but the services figures continue to come down, driven by shelter. then I don't necessarily think that means we're suddenly going to see a massive spike in terms of US inflation to hold back the Federal Reserve. Like I said, we've kicked off in positive fashion here with the S&P 500. This is something that I've been talking a lot about recently, right? We were talking about, is this a pullback for a Santa rally? And I mentioned that this was likely going to be exactly that. Or we were talking about a stochastic crossover towards the upside, which happened. We were talking about a move into trendline support, which happened as well. Or we just front run it, I think, on the trendline support. It's like that. Well, excuse me. So we were talking about it as a potential Santa rally, which initially happened, but Santa was pretty fleeting in nature. So we sort of popped and then started to roll over once again. So then I've provided that week ahead video, which sort of outlined my view that this is a retracement before the bulls come back into play once again. That's exactly how it has played out. Of course, we still have got some question marks to say, this could be still another retracement and that we're within a sort of symmetrical triangle formation. I don't think it's necessarily likely, but if we see the move through your 6044, then of course that gives us greater confidence that we are done essentially, and we're going to be hitting record highs from here onwards. So, ultimately it pays to look further out, right? Don't get too spooked when you see a bit of a pullback over the course of a couple of days, because the trend is well and truly your friend. And you can't go from thinking everything's amazing, the US economy is going to do incredible, to suddenly thinking you're going to see like a correction of 10% or something like that. It just doesn't seem likely in my mind. And that's pretty much how it's played out at the moment. It's looking like the bulls are back in charge. The Russell 2000 is another one I've been talking about recently. Part of it comes down to, do we see more or less rate cuts? And that's why it's interesting when it comes to this jobs report, because if we see higher unemployment, a weaker payrolls figure, weaker wage growth figure, those are the kind of things that lift expectations from the Fed that they might cut and ease more, and that should be positive for the Russell 2000. Remember though, that story about Donald Trump being more targeted and tactical when it comes to tariffs, that's not necessarily positive for the Russell 2000. Companies within this index are likely to want to be shielded from international competition because they're less likely to be highly international in nature compared to those within the S&P 500, for example. So we do see some bullish sentiment coming back into play. But certainly if we see weak data, I think that provides the basis for further strength. But like I said, we've pulled back, we're in trendline support here, and now breaking up through this neckline, which provides us with that double bottom formation here. So I do think there's a good chance that the bulls are going to remain in charge unless we break below this 2202 support level established at the back end of 2024. And finally, like I was saying, we're talking about the sort of pop that we've seen in terms of euro yields versus US yields. This is the 2-year for both of them, the relative 2-year for the Eurozone versus the US. And that has helped euro dollar pop a little bit as well, with some weakness for the US dollar as equity markets move towards the upside. And bear in mind, if Donald Trump wants the world to be buying more US goods, I don't think that necessarily goes hand in hand with a really strong US dollar. So, yes, we've seen a strong period for the US dollar, and there's certainly an argument when it comes to trading against the euro, because we're likely to see continued weakness in terms of the rates at the ECB. But from a long-term perspective, over the course of 2025, I wouldn't be surprised to see sort of bullish mood within markets and the dollar showing some weakness. And that's exactly what happened with Donald Trump. Initial strength when he first came into power last time around, but then throughout the years that followed, we did see significant weakness for the greenback. But as we see here, we've seen a bit of a pop coming into play, a very clearly defined downtrend here. And so if we break the 104.58, that's when it looks like we're potentially going to continue to extend this move towards the upside. But as things stand, we've rallied into a very deep retracement. I think it's probably gone past all the fib levels. Yeah. So it's gone past 76.4, which is a warning sign and does point towards a possibility of that breakout on an intraday basis. But we're starting to roll over. So like I said, 104.58 is the key level to be looking out for, that needs to break for that downtrend to come under pressure and the bulls to start showing their hand once again. And arguably there's some basis for that, given the pop that we've seen recently and the breakout from that correlated relationship between the euro 2-year and the US 2-year, ratio versus euro dollar. So a key one, and certainly a really interesting really interesting report coming out on Friday. And remember, it's not the only thing that's going to be coming out over the course of the weeks. We've got the JOLTS job openings, we've got the ADP, we've got the jobless claims, we've got the FOMC minutes, and then Friday we've got the jobs report. So plenty to sink your teeth into. I hope this has helped you. Make sure to like and subscribe and follow the account for more videos like this.